Okay, everybody. Here we're going to do lecture module 9, part A. This is 9A. We're in week 5. And what we're going to deal with here is the topic of what we call efficient capital markets. Efficient capital markets. A key idea we need to turn our attention to, we're now dealing with the right-hand side of the balance sheet, the right-hand side. And what we want to do is look at the structure of the firm. How is it structuring its sources of funds, right? Before we were dealing with uses of funds. Now we're dealing with the structure of the sources of funds. And when we do this, to keep it relatively simple, or simpler, we need to address the question basically of financing the trade-offs between debt and equity. And we're going to just basically garden variety debt and equity, okay? We're not getting into the issue of short-term or long-term debt. We'll just look at sort of undifferentiated debt for an introduction. Later, if we get into capital structure in detail, we'll look at differentiation issues. And we'll not begin really to address the very complex sources of funds. Financial securities that might be puttable bonds or convertible debt, convertible preferred stock, warrants. Those are somewhat exotic securities. And so we're going to look at capital structure under the special simple case, and this lays down foundations, and you take lessons from this to apply a little bit more advanced techniques to the exotic types of securities. So when we make this capital structure decision, we're going to have to establish that the two other financial decisions are going to be given. So given that, right? Given that, first that we're going to hold the capital budgeting decision constant, right? Investment decisions are held constant. That makes it a little easier for us to isolate the issues related to our right-hand side. And we're going to hold dividend policy constant. Dividend policy should be constant. Again, investment and dividend policy decisions can change the firm value, and so we want to hold those decisions constant to isolate the impact of the capital structure decision on the value of the firm and thus on shareholder wealth. And so once again, our optimal capital structure. This would be an arrangement of debt and equity in particular proportions, which can only really be understood from a particular perspective. Remember, from the perspective that we will attempt to maximize, right? This is our goal, maximize shareholder wealth. So again, everything here makes much better sense when we have this general goal understood and established. Okay. Now, in considering this topic, Burke and DiMarzo here we're looking at structure and capital structure. Keep in mind, sometimes these terms can be confusing, and I think the book does a good job, but for our purposes, let's be clear that we're referring to all of the accounts on the right-hand side of the balance sheet, okay? All of the sources of funds. And all right, these sources have explicit costs that are often referred to as the capital structure. So there's a difference between the term financial structure and capital structure. right? You have non-interest-bearing liabilities like accounts payable and wages payable and taxes payable, for instance. That's a differentiating point to watch for. So now when we do this, what we want to do, of course, is consider the prices of securities. This is our main takeaway point to watch for. Part 1, I guess we'll call it. And let's note what we have thus far discovered, right? That the price of any asset, whether it's real or financial, the prices are determined, right, using a discounted future cash flow model. The price in time period 0 and time period 0 would be the sum of, say, cash flows. Now these cash flows run from time period 1, right, to time period t. And let's label them cash flows, right, that operate in a particular time period. And those are discounted at 1 plus r to the t. And P0 would be, right, the price of the asset today at time period 0. And, right, the cash flow CF sub t, the after-tax cash flow at time period t. And n is the number of periods where n is the final cash flow of interest, right? And r is the risk-adjusted required rate of return. So after working with capital budgeting, this is a fairly straightforward equation. And you should also feel a lot more comfortable now about figuring, say, what it is that is the determinant of our value r. And keep in mind, right, for equity, we should state that the value t, the time of holding, right, it approaches infinity because corporations are, for all purposes, infinite in their lifespan, or at least from the point of view of the current holders of the equity. Now, in capital budgeting, remember, the evaluation of the projects established our general rule. We hope to find positive NPV opportunities. And remember, the general rule was that when we invested in real assets with positive NPVs, right, positive NPV assets, right, when we did this type of investment, we're assured generally that we're going to increase shareholder wealth, right? We're going to increase shareholder wealth by the value of the net present value that we're kind of loading into the asset structure, right? So shareholders should be relatively supportive of these positive NPV assets due to the wealth effect. Now, there are market imperfections in real asset markets that can be, remember, they can be the source of shareholder wealth increases in regards to these capital budgeting decisions. Now, remember what these market imperfections represent. They're deviations from the long-run competitive equilibrium. So you have the long-run equilibrium in the competitive sector, the long-run demand curve. We have average costs of operations across a range of possible levels of output. We denote Q star, which under the marginal cost equals marginal revenue rule has established for us zero profit, right? Zero profit. So an imperfection is a situation, right? It's a situation when instead of a perfect kind of market situation, the imperfections cause profits to exceed zero, right? So positive profit in the general economic model, say from price theory, managerial economics. Here we're now putting it in terms of the financial effect, right, of the discovery of such a project. Something profitable. Revenues exceed, right, total revenues are greater than total costs. And this, of course, is one of the great rules of success, and I call it rule number 2, remember, rule 2. Rule 1 was being better before being cheaper. And this leads us to identify projects that generate net gains. Now, some of the sources of the market imperfections are crucial for us to note. Recall the sources of market imperfections. This is the key. Think of it as an MBA skill, a management skill that is rare enough to be worth quite a bit. And this is the ability to create and exploit barriers to entry. We'll learn about that much more in detail when we study this in policy. You could also, of course, produce goods and services at lower cost. So you could be a cost leader in a market, and that's going to, of course, be worthwhile. Or you could convince consumers that your products are a higher quality, that you're better, right? You're better. Right? Better than, right, the value propositions that are posed by your competitors. So we'll call it, say, better than competitor value propositions. Of course, you could also be first in a market, or you might be a second mover and have improved upon first mover kinds of products. Apple, of course, right, is a famous second mover into markets. Right, if all of the real asset markets were perfectly competitive, then the positive NPV projects would be bid away. There would be that pressure. The law of one price would be operational. Right? If any of the positive NPV projects actually existed, the competitors would come in flooding the market, and that lowers prices and increases expenses so that NPVs eventually they're going to reach zero. So, of course, this zero profit competitive equilibrium is this lesson straight from economics. Under such an environment, you would earn what we call a fair rate of return on your investment. Kind of a rate of return that is commensurate with the risk, right, that the project exhibits. Now, so of course, this is a highly idealized situation, and we don't expect that it will be exactly true often. We do expect to be able to identify markets that are imperfect. How, right? How? So we have the same objective with respect to decision on the right-hand side of the balance sheet. Here we want to find combinations of financial securities that maximize shareholder wealth. And in order to do this, you have to find positive NPV opportunities that exist because of market imperfections in the capital markets. So, for instance, in capital market imperfections, a couple of themes arise. It could be that there's, say, the issuance of securities that firms will undertake. And it might be that those securities that were issued are worth less than the proceeds that the firm receives, right? So you have a firm that issues equity, for instance, or bonds, selling them, getting a large amount of inflow of cash, and those securities wind up actually being much less of value than the monies that actually were transferred to the firm. And of course, another kind of imperfection would be, say, we'll say, buying securities, not issuing them, but buying securities that are worth more than they cost. Similarly, to any real asset market, when there are perfect capital markets, a firm would generally be unsuccessful in creating value for its shareholders by just changing its capital structure. The idea there would be, right, any capital structure would be good as any other capital structure. This will be demonstrated later in the text. So if capital structure is to matter, that is, if it's going to have an impact on shareholder wealth, it has to be the case that the structural issue, right, is related to the existence of a market imperfection. So think of, say, real asset markets versus, right, capital markets, and come up with a few key issues. Here's what we know based on evidence. The evidence suggests that opportunities to find and exploit market imperfections in terms of the investment opportunities in product markets, that's the left-hand side of the sheet. Such opportunities far outnumber the opportunities that exist in terms of us trying to find and exploit imperfections in terms of the pricing of financial assets, the right-hand side of the sheet. The reason for that imbalance, right, so real asset markets, right, you got more opportunities, more imperfections that can be discovered. Many more, right? In the financial markets, much less opportunity exists. The reason for this imbalance is, right, the opportunities that arise in the capital markets face far greater competition. Right? The existence of and the ability to create close substitutes for financial assets is very, very strong in these markets. So thus there's fewer market imperfections. In reality, many of the sources of the imperfections, as they relate to the investment opportunities in the real assets, either really don't exist at all in the capital markets, or in fact there's just the imperfections or the impacts are just very, very small. See, if capital markets were utterly perfect, right, all of the financial securities that are available in the market, they should be fairly priced, we say. By being fairly priced, that, well, we know that the prices would basically reflect all that is known and knowable about future cash flows and risks of a security. So in such a world, the financial securities would plot on the SML. Securities plotting on the SML results in, right, the NPV, the net present value from investing or selling securities, should be 0. If the prices are fair, or say if they're right, this is establishing a crucial condition that, right, known, we say known and knowable, right, knowable information, right, on the future cash flows, on CF, and on risks. That's going to be, say, we call it capitalized, embedded, reflected in the prices of securities. If all that is known and knowable, if all of it is known and knowable, then the pricing of the security would be efficient. The capital markets would be efficient. Efficient capital markets are the main concept that we've got to establish. That known and knowable data, right, is reflected in the prices of securities. Capital markets are efficient capital markets. And there's this hypothesis, right, that states that the capital markets are efficient. It's called the EMH, the efficient markets hypothesis. The subject of a great amount of scholarly study. So by definition, if capital markets are perfect, right, PCM, perfect capital markets, then they have to be efficient. This inefficiency, the idea inefficiency implies imperfections, right? So inefficiency, if there is inefficiency that's discovered, then you have some kind of market imperfections that exist. Another way of thinking of that is somehow the law of one price is not operating. It turns out there's no other proposition in economics and finance more heavily studied than the EMH. And so there's been a tremendous amount of work gone into an attempt to discredit this, and really there are some exceptions, but for the most part the evidence overwhelmingly supports the efficient markets hypothesis. So this raises our lecture material to the issue of information and its link with market efficiency. In essence, the EMH can be divided into 3 distinct levels for testing. Right? You have the weak, the semi-strong, and you have the strong efficient markets hypothesis. And so what we're going to do is look at basically the issue of how the EMH is concerned with what's happening in markets. How do markets digest information? How do markets react to new information? And what we'll do is basically think about each of these forms in terms of basically the access to information, the new information that's being made available. How is it being processed and accessed, right? That is information efficiently acquired, and people reacting to it quickly and appropriately, right, without making mistakes and so on. And the text actually has an excellent figure indicating relationships that exist between different information sets that are available to the market participants, right? So we'll look at basically how information sets are changing as you move from the weak through semi-strong to the strong hypothesis. Right? So that's the first basic part of our week, and what I'll do is continue in the next tablet lecture.